Imagine this. You're maybe, casually selling some vintage finds online. Or maybe you're really crushing it with a side hustle, getting paid through apps you use every single day.
Yeah, everything feels smooth, easy, totally frictionless.
Right. But then, one day, maybe in your mailbox, maybe your inbox, this form appears. You didn't expect it. Maybe it looks a little intimidating. Form 1099-K.
Mm-hmm.
It feels like the IRS is suddenly taking a deep dive into your digital wallet, asking about all this money flowing through your accounts. Are you ready? Ready to understand it, and more importantly, maybe save yourself from overpaying taxes.
And look, this isn't just another piece of paper hitting your desk. This form, the 1099-K, it really signals a profound shift. It's about how the IRS views and frankly tracks our financial lives now in this, digital age.
It's not just about what you earned, right?
Exactly. It's about what was reported about your earnings by third parties. And understanding that crucial distinction between those two numbers, it's absolutely vital for your peace of mind, for accurate tax reporting, and yeah, like you said, for making sure you don't pay a penny more than you legally owe.
That's such a critical point, and that's really why we're here today. We're going to do a deep dive into Form 1099-K.
Let's do it.
We'll demystify exactly what it is, uncover why you might get one, and walk you through what every single box on it actually signifies.
Mm-hmm.
But here's where I think it gets really fascinating and honestly financially empowering for you. Our main mission today, it's to equip you with the knowledge to interpret this form correctly,
Right.
to make sure you're paying only what you owe. We'll show you how to navigate those essential nuances, that difference between what's reported as gross income and what truly counts as your taxable income.
Yeah, that gross versus net thing is huge.
Think of this as your essential guide, maybe your shortcut, to mastering this evolving tax landscape of digital transactions and protecting your hard-earned money.
Okay.
So let's unpack this alphanumeric puzzle, the 1099-K. What exactly is it? Sounds a bit like alphabet soup, maybe.
It does a bit, yeah.
But its purpose is actually quite straightforward once you understand its role in our modern financial world.
Right.
At its core, the 1099-K is officially known as the Payment Card and Third-Party Network Transactions Form. That's the full name.
Catchy.
Totally. But it's an informational return. That's a really key distinction. It's not a bill. It's not an invoice.
No, you don't owe money just because you got it.
Exactly. It's a report. It's basically designed to give the IRS a clear picture of the sheer volume of money that flowed into your accounts from specific types of digital payment sources during a calendar year.
And what's really fascinating here, if we kind of connect this to the bigger picture, this form is a direct reflection, maybe even a response, to the explosion of digital payments in our everyday lives.
Right. Everything's digital now.
Think about it. A decade or two ago, most transactions were cash, maybe paper checks. Very little digital trace. Today, almost every transaction leaves some kind of digital fingerprint, whether you're, swiping a credit card at your local coffee shop, maybe you're a small business owner.
Or like our example earlier, someone selling vintage stuff online.
Exactly. Like Sarah selling unique finds on Etsy or eBay, or maybe David offering services as a freelance graphic designer through an online marketplace.
Or driving for Uber, delivering for DoorDash.
All these transactions are being digitally captured, processed, and the 1099-K. It's the IRS's way of ensuring more transparency in this, digital economy.
Making sure that income doesn't just disappear.
Pretty much. Making sure income generated through these modern payment methods gets accounted for. It really represents a fundamental shift in how tax authorities gain insight into our financial activities.
That's a really crucial point. It's about transparency, not just for big traditional businesses, but for anyone participating in the digital marketplace.
Yeah, absolutely anyone.
So who is actually sending these forms out? Because it's not the IRS directly, right? They don't just mail these out themselves.
No, there are specific entities that have a legal obligation to record this info.
Yeah.
On the form itself, they're called filers.
Filers.
And they typically fall into two main categories: payment settlement entities, or PSEs,
CSEs.
and electronic payment facilitators, often called EPFs.
Got it. PSEs and EPFs.
These entities, these PSEs and EPFs, they act as this critical bridge in the whole digital payment ecosystem.
How so?
Well, they're the ones processing the payments on behalf of sellers or service providers like Sarah or David. So we're talking about companies everyone knows, right? PayPal, Stripe, Square.
The big names.
Yeah. Or even the platforms themselves if they handle the money directly, like eBay, Etsy, maybe even smaller niche marketplaces where you might sell specific digital products or services. And because they handle the actual flow of money, they're in this unique, powerful position to give the IRS that bird's eye view of the gross transaction volumes.
So it's required by law.
Absolutely. This mandate to report is written right into U.S. law, specifically Internal Revenue Code Section 6050W.
Section 6050W, okay.
It was enacted precisely to make sure income earned through payment cards and these third-party networks doesn't just, fly under the radar.
Makes sense.
Essentially, the IRS isn't trying to guess anymore or piece together your income. They're getting direct aggregate reports from the very companies handling your money.
Wow. That sounds efficient for them.
Oh, it's highly efficient for them, which makes it really incumbent upon every individual, every one of us, to understand what's being reported about us.
Which brings us right back to that big question for so many people. Why did I get one?
Yeah, that's the surprise factor often.
Because it often catches people off guard, especially if you don't really think of yourself as a traditional business or like a full-time entrepreneur. The straightforward answer is, you got a 1099-K because you either, one, accepted payment cards for payments, so credit or debit cards, or two, you received payments through a third-party network during the calendar year.
And it's that second part, received payments through a third-party network, where so many people, especially maybe casual sellers or gig workers, get caught off guard.
Yeah, that seems like the broader category.
Totally. It's not just your traditional brick-and-mortar shops getting these anymore. Let me give you some concrete examples, things that probably resonate with a lot of listeners.
Okay.
You might get a 1099-K if you're an individual like Sarah, selling items regularly on an online marketplace. Maybe you're decluttering your closet on Poshmark, selling handmade jewelry on Shopify, or dealing collectibles on eBay. It's also incredibly common for gig workers like David, rideshare drivers, food delivery folks, freelance designers, writers, consultants, virtual assistants.
Anyone using those platforms.
Anyone offering services through online platforms where the payment is processed by a third party. And of course, your traditional small business owners using a point-of-sale system like Square or Clover, that accepts credit cards. They'll absolutely get one.
Okay, but this is where it can get a little tricky for some people, right? Even confusing.
Right.
What if you used Venmo or PayPal just to get money back from a friend, like for a shared gift?
Right. Or splitting dinner.
Yeah, or splitting dinner, or covering your share of like a vacation rental, personal stuff.
Yeah, this is a really common point of confusion. While many purely personal transactions are not intended to be reported for tax purposes.
Right, they shouldn't be income.
They shouldn't be.
Yeah.
But if these payments, even personal ones, push you over certain reporting thresholds set by the IRS.
There are thresholds.
Yes, there are dollar amount and transaction count thresholds for third-party networks. And even if those thresholds have changed over time, the principle holds. Or, and this is important, if the payment processor categorizes those payments incorrectly.
Oh, like if your friend accidentally marked it as goods and services.
Exactly. Then a 1099-K could theoretically be generated for those amounts.
Wow. Right.
And this highlights a crucial point. Even if your activity feels totally casual or purely personal, if you met those reporting thresholds, the payment processor is obligated to report the gross amount to the IRS.
They have to.
They have to, which leads us to a really strong warning. This comes directly from the IRS itself.
Okay, what is it?
The key takeaway here is, do not ignore this form.
Don't just toss it.
Absolutely not. It's not just a suggestion to look at it. It contains important tax information, and remember, the IRS already has a copy.
They know you got it.
They know. And the official guidance, right on the form instructions, explicitly states that a negligence penalty or other sanction may be imposed on you if taxable income results from this transaction and the IRS determines that it has not been reported.
Whoa. Negligence penalty. That sounds serious.
It is. That's a powerful warning. It indicates that understanding this form isn't just about, good financial hygiene. It's a necessity for sound tax compliance and for minimizing potential penalties down the line.
So it's about being proactive, not reactive.
Precisely. Especially when it comes to your digital income.
Okay, so you've received your 1099-K. It's in your hand. It might look a bit daunting, all those boxes, all those numbers staring back at you.
Yeah, it can be intimidating at first glance.
But let's break it down, section by section, starting with the basic identifying information. Think of this as like your user manual for navigating the form.
Good analogy.
Because understanding each part is really your first step towards smart tax management and ultimately effective tax savings.
Exactly right. So at the very top, you'll see the filer's name and address. This identifies the payment settlement entity, the PSE, or the electronic payment facilitator, the EPF, that actually issued the form. So this is where you'd see names like PayPal, Stripe, Square, or maybe a specific marketplace like Etsy or eBay if they acted as the direct payment processor.
And why is that important?
This info is absolutely crucial. Because if you have questions, if you spot a discrepancy, if you think something's wrong and need a correction, they are your first point of contact, not the IRS.
Ah, okay. Go to the source first.
Always. Having their name and address right there makes it easy to reach out.
Got it. And right below that, you'll find the payee's name and address. That's your information.
Correct. Always a good idea to just quickly glance and verify that's accurate, matches your records.
Makes sense. Then there are the TINs, taxpayer identification numbers, the filer's TIN, and the payee's TIN.
Right. And for your protection, on the copy you receive, your TIN-EM, whether it's your Social Security number, ITN, ATN, or maybe an employer identification number, an EIN, it might only show the last 4 digits.
Okay, for security?
Exactly. But, and this is critical to remember, the issuer has reported your complete TIN to the IRS.
Ah.
This detail really underscores that direct, undeniable data link between the payment processor, your reported transactions, and the tax authorities. They know precisely who you are and precisely how much money was processed under your name and TIN.
Okay, that's clear. What else is in that top section?
You'll also usually notice the PSE's name and telephone number, typically found in the lower left corner of the form, just above your account number.
Another point of contact.
Exactly. Another crucial point of contact for inquiries, especially if you maybe don't immediately recognize the filer listed right at the very top. Sometimes a smaller payment facilitator might be the official filer, but they're working under a larger payment settlement entity, the PSE.
Okay, so there might be 2 names involved.
Potentially. Having both contacts can be incredibly helpful for tracing transactions or just tracking down information if you have questions or suspect an error. It gives you multiple avenues for clarification, which can save you a lot of headache down the line.
Definitely good to know. Okay, now let's get to the core financial details, the numbers.
Yes, the money part.
These boxes tell the story of the money that moved through your accounts. Understanding them is paramount for accurate tax reporting and, crucially, for reducing your taxable income. Where do we start?
First up, and arguably the most important box on the whole form, is Box 1A, gross amount of payment card third-party network transactions.
Box 1A, gross amount.
This number represents the total dollar amount of reportable transactions made to you through that payment settlement entity during the entire calendar year.
Okay, the total. Seems straightforward.
But this is, without a doubt, the most frequently misunderstood box. And it's where truly careful tax planning and potentially significant tax savings really begin.
Why is that?
The critical nuance here, and I really can't emphasize this enough, is the gross nature of this amount. The IRS instructions for Form 1099-K explicitly state that this amount is reported without regard to any adjustments for credits, cash equivalents, discount amounts, fees, refunded amounts, shipping amounts, or any other amounts.
Well, wait. Say that again. Without regard to.
Fees, refunded amounts, shipping amounts, credits, discounts, basically anything that might have reduced the amount you actually kept.
So let's use our example. Sarah sells a vintage dress for $100. The buyer returns it, she refunds the $100. And maybe the platform charged her a $5 listing fee. Box 1A still shows.
Box 1A will still show $100 for that initial transaction. It doesn't reflect the refund, it doesn't reflect the fee, it doesn't reflect the true amount of money she actually kept from that whole interaction, which was negative $5.
Wow. Okay. That is a huge distinction.
It's enormous.
So if you were to just take that Box 1A number and plug it directly into your tax return as your income without making any adjustments.
You would almost certainly be overpaying your taxes. Significantly, sometimes.
Because you'd be paying tax on money you never actually pocketed. Or on money that was a legitimate expense.
Exactly. It's like the 1099-K gives the IRS the starting line of the race, maybe the total distance covered, but it's entirely up to you to show them the finish line, your true profit, after accounting for all the costs and adjustments.
So accurate record keeping is everything here.
Absolutely vital to ensure you only pay tax on your actual net profit. This isn't just about compliance, it's about smart tax strategy, saving yourself money.
Okay, Box 1A, gross amount. Understood. What's next?
Then we move to Box 1B, card not present transactions.
Card not present. What's that?
It simply relates to sales where the physical card wasn't, well, present during the transaction, or maybe the card details were keyed in manually.
So online sales, Phone sales.
Exactly. Online sales, phone sales, catalog sales. It helps classify the nature of your transactions, which could be useful if you have a mix of, say, in-person craft fair sales and online Etsy sales.
Okay. Is there anything tricky about this box?
There's an important caveat. Comes directly from the source material for the form instructions. It says, if the box for third-party network is checked, or if these are third-party network transactions, card-not-present transactions will not be reported.
Huh. So it's mostly PayPal or Venmo.
Right. If most of your transactions are through those kinds of third-party networks, you might just find Box 1B is empty. And that's completely normal. Don't worry about it.
Good to know. Okay, what's box 2?
Box 2, Merchant Category Code, or MCC.
MCC code. I think I've seen those on credit card statements.
Exactly. It briefly explains the general category for the type of business if one is available and assigned. It's basically a classification code, like retail sales, professional services, restaurants.
Does it affect the money part?
Not directly, no. It doesn't impact your reported income amount in Box 1A, but it helps the IRS categorize your business and the nature of your reported transactions.
So maybe if you're a freelance writer, but your code says restaurant.
Yeah, that might be a mismatch that could potentially raise a question down the line, which again just emphasizes why your own meticulous records describing your actual business are paramount.
Makes sense. And box 3.
Box 3 is pretty straightforward. Number of payment transactions, just
Let it count.
just a simple count. And the form explicitly notes not including refund transactions, so it's just the count of incoming payments. Again, it's another data point for the IRS to potentially reconcile things with.
Okay, boxes 1A, 1B, 2, and 3. Got it. What else is key?
Then there's a really important box, one that can actually lead to immediate tax savings for you. That's box 4, federal income tax withheld.
Tax withheld, like on a paycheck.
Exactly like that. This is crucial. This amount represents what's known as backup withholding.
Backup withholding. Why would that happen?
It generally occurs if, say, you didn't provide a correct taxpayer identification number, TIN, to the payer when you signed up. Or maybe if the IRS notified the payer that you were subject to backup withholding for some other reason, like underreporting income previously.
Okay, so it might seem like a negative thing to have tax withheld.
It might feel that way initially, but the critical implication here is that you must include this amount on your income tax return as tax withheld.
Ah, so it's money you already paid towards your taxes.
Precisely. It's a direct credit against your total tax liability. It immediately reduces the amount of tax you owe, dollar for dollar, or increases your refund.
So definitely don't ignore box 4.
Absolutely not. It's free money, in a sense. Money you've already paid. Don't forget to claim it. It's a surprisingly common oversight.
Good tip. Okay, what about the block of boxes labeled 5A through 5 down?
Ah, yes. Boxes 5A, 5 pound. Monthly breakdown. This is where the form gets really detailed and actually incredibly helpful for your own personal bookkeeping.
Monthly breakdown.
Yes. These boxes show the gross amount of transactions, again, that gross amount from Box 1A broken down for each month of the calendar year. January, February, March, all the way through December.
Wow, that is detailed. How is that helpful?
Oh, this monthly breakdown is invaluable. Seriously. It allows you to reconcile your own monthly sales records with what was reported by the payment processor. It's a fantastic tool for robust bookkeeping.
So you can check their numbers against yours month by month.
Exactly. You can easily spot discrepancies, maybe track seasonal income patterns, like if you sell more crafts near the holidays, or just identify months where you had unusually high activity.
And if the numbers don't match for a specific month.
That's your immediate cue to investigate, to contact the filer, the payment processor, and figure out why. If you're diligently managing your finances throughout the year, this section provides a really easy way to verify that cumulative total in Box 1A. It builds confidence in the numbers.
That makes a lot of sense. Good internal check.
Very good check.
Okay. And then boxes 6 through 8 looks like state taxes.
Correct. Boxes 6 through 8 show state and local income tax withheld, if any.
Similar to the federal withholding in box 4.
Exactly the same principle, just at the state or local level. If amounts were withheld for state or local taxes, they'll appear here. And just like Box 4, these amounts should be reported on your respective state and local income tax returns.
As credits against state or local tax owed?
Precisely. Again, direct credits against your state or local tax liability. So they're important for accurately calculating what you might still owe at those levels, preventing overpayment there too.
Okay. So putting it all together, what does this really mean for me, the listener?
It means the IRS isn't just, guessing about your digital income anymore. They have a detailed picture, often month by month,
Hmm.
of the gross money flowing through these payment platforms to you.
And that detailed picture.
That detailed picture is precisely why our next section is so absolutely critical for your wallet, because it tackles the biggest tax-saving opportunity this entire form presents: how to get from that gross number to your actual taxable income.
All right, here's where it gets, I think, really interesting, and where understanding this form can genuinely impact your tax bill, save you significant money.
This is the core issue, really.
We keep saying Box 1A shows a gross amount,
Yeah.
but is that your taxable income?
No, absolutely not in most cases. Not necessarily at all. This is perhaps the single most important distinction you need to grasp when you're dealing with a 1099-K.
And ignoring it is costly.
It's one of the most common and, most costly mistakes taxpayers make with this form. Huge potential for overpayment if you miss this.
Okay, explain that disconnect again. Why isn't Box 1A my taxable income?
Because, as we said, the 1099-K reports the total dollar amount processed, the gross amount. It does not inherently account for, well, the real costs of doing business.
Like fees.
Fees, yes. Or money that wasn't actually income in the first place, like maybe those personal reimbursements we talked about. Or, critically, money that you refunded to a customer.
Okay.
This distinction, gross versus taxable, it's paramount. For accurate tax reporting, yes, but really for avoiding overpayment. You are taxed on your net profit.
Net profit. So income minus expenses.
Basically, yes. Your actual income minus your legitimate business expenses, not simply the gross sales amount that shows up in Box 1A.
Let's use Sarah again, the vintage seller. Her Box 1A shows $10,000 from online sales.
Okay, sounds like a decent amount.
But what if, say, $2,000 of that was for items she had to refund?
Okay, so $2,000 wasn't kept.
And maybe $500 went to platform fees and transaction fees.
Another deduction.
And maybe $300 was collected specifically for shipping, which she then paid directly to USPS.
Right, a pass-through cost.
And let's say another $1,000 was her actual cost to acquire those vintage items in the first place, the cost of goods sold.
Okay, significant costs there.
So if she just reported $10,000 as income, she'd be paying tax on money she never truly kept, or money that was an expense.
Exactly. Her actual taxable income in that scenario is much, much less. It's $10,000 minus $2,000 minus $500 minus $300 minus $1,000. What's that? $6,200.
Right. A huge difference from $10,000.
Yeah, a massive difference. That's the gross amount trap. And avoiding it requires knowing what the 1099-K doesn't deduct, but you absolutely can and should deduct on your tax return.
So that list from the instructions, without regard to credits, cash equivalents, discount amounts, fees, refunded amounts, shipping amounts, that's basically my checklist for deductions.
That list is your direct roadmap. It's telling you exactly what isn't factored into Box 1A, and therefore what you need to track and potentially subtract to get to your true taxable income. It translates directly into real tax savings. Let's break down how each of those can save you money.
Okay, first up, refunds. This seems obvious, but how does it work with the form?
Right. It seems obvious, but it's surprisingly easy to mess up if you're not careful. If you issue a refund to a customer, maybe a product was returned, service canceled, whatever the original gross transaction amount for that sale is still included in your Box 1A total.
Even though the money went back out.
Even though the money went back out, that refunded amount is absolutely not your income. It left your hands. So you must meticulously track every single refund you issue.
So if Box 1A shows $1,000 gross, but I refunded $200.
Your actual sales income from those specific transactions is only $800. If you don't subtract those refunds when you calculate your income for your tax return, you'll be paying tax on an extra $200 you never kept. It's a simple adjustment, but vital. Keep those refund records.
Okay, refunds tracked. Next, fees. This feels like a big one for online sellers.
Oh, it's huge. Absolutely massive for anyone using digital payment platforms or marketplaces. Payment processing fees, platform commissions, listing fees, transaction fees.
Add up fast.
They really do.
Yeah.
If you're using any of these third-party payment networks, you are almost certainly paying various types of fees. And here's the good news. These are legitimate business expenses.
Directly deductible.
Directly deductible. If PayPal charges you, say, 2.9% plus 30 cents per transaction for every payment you receive, those charges directly reduce your net income. If Etsy takes a percentage of your sale as commission, or eBay charges you listing fees, or Square charges you for using their POS system.
All deductible.
All deductible expenses. You absolutely must track these. Download those monthly statements from the platforms, add them up. They are a direct reduction of your taxable income. Don't let those small fees just slip away unnoticed on your taxes. They can amount to hundreds, even thousands of dollars in deductions.
Okay, track all the fees. What about shipping amounts?
Another critical area, especially for people selling physical goods online, like Sarah. Money often passes through your hands for shipping, but it isn't truly income.
If you collected it just to pay the carrier.
Exactly. If you collected money from a customer specifically for shipping and then you immediately paid that exact amount or close to it to a carrier like USPS, UPS, or FedEx, that's often considered a direct pass-through cost. It's not your income.
So sell an item for $50, charge $10 shipping, pay $10 to ship it.
Your actual income from that transaction is still just the $50 for the item. The $10 for shipping was never truly yours to keep. It was just a reimbursement for an expense you immediately incurred.
And if I don't account for that?
You're, again, paying tax on money that simply passed through your hands. You need records showing how much you collected for shipping and how much you actually spent on postage and shipping supplies.
Got it. What about credits and discounts?
Similar principle. If you offer a discount on a product or service, maybe a 10% off sale, or you give store credit for a future purchase, the initial gross amount reported on your 1099-K might be the pre-discount price.
The full price before the discount was applied.
Potentially, yes. Depends on how the platform processes it. But your actual income from that sale is the net amount you received after that discount or credit was applied. If an item is listed at $100, but you sell it for $90 due to a promo code.
My income is $90.
Your income is $90. You need to make sure your own sales records reflect the net amount you actually received. Again, seems small maybe on one transaction, but for a high-volume seller, these discounts add up. Don't pay tax on the discount you gave away.
Makes perfect sense. Okay, now let's tackle that tricky one. Personal reimbursements and other non-income transactions.
Right. This causes a lot of confusion and anxiety, especially with apps like Venmo, Zelle, Cash App, PayPal Friends and Family.
Where people mix business and personal.
Exactly.
Yeah.
What if you used one of those apps simply to receive money from a friend for a shared gift? Or a reimbursement for your share of dinner, like we said, or someone paying you back for concert tickets, or their share of an Airbnb.
Yeah.
The 1099-K form itself, it doesn't differentiate. It doesn't know if that $50 payment was for freelance work or for pizza money.
So it may still get reported.
It might get reported if it contributes to you hitting those reporting thresholds, either the dollar amount or the number of transactions, depending on the rules in effect for that year. But, and this is key, that $50 you got from your friend for pizza is generally not taxable income.
But the IRS might see it reported on the 1099-K.
Correct. This is where the burden of proof falls entirely on you. The IRS only sees the reported gross amount. If you receive a 1099-K that includes these purely personal reimbursements, you have to be able to demonstrate that they were non-income transactions.
How do you do that?
Meticulous records. Without clear, robust personal record keeping, the IRS just sees the reported amount and could potentially assume it's taxable income. Imagine trying to explain to an auditor, maybe months or years later, that a specific $500 Venmo payment was for a group vacation rental, not for services you provided.
Sounds tough without proof.
Very tough. Without a clear digital trail notes in the payment app memo line, corresponding receipts, maybe separate bank accounts, that explanation becomes very difficult to substantiate. This is why the advice is often to keep personal and business transactions completely separate if possible, or, at the very least, label every single transaction with meticulous detail in your own records.
Good advice. Label everything.
Label everything. If David, our freelance designer, also uses Venmo to split bills with friends, he needs a rock-solid system to differentiate those client payments, income, from the personal money exchanges, not income.
Okay, so the golden rule here seems abundantly clear.
That's that.
You are taxed on your net profit, not necessarily the gross amount reported on your 1099-K, especially if you're operating any kind of business, even a tiny side hustle, or if you have personal reimbursements mixed in.
That is the absolute bedrock. That distinction is the key to intelligent tax planning and potentially significant tax savings when dealing with this form. It's about being precise, telling your accurate financial story.
So what does this all boil down to for you, the individual listener trying to navigate this? It sounds like it means becoming your own financial detective for every single digital transaction.
That's a great way to put it. Financial detective. I like that.
It means that the absolute necessity of meticulous record keeping isn't just like a suggestion from accountants.
Right.
It's essential. It's fundamental to preventing you from overpaying your taxes.
Absolutely. You need to proactively track all your sales and service income using your own records. That's your primary source of truth, not just the 1099K.
Like building your own accurate financial diary throughout the year?
Exactly. And equally important, maybe even more important for tax savings, is tracking all expenses related to those sales or services.
We mentioned fees, shipping, cost of goods.
All of those. Every single fee, payment processing, platform commissions, listing fees, your cost of goods sold if you're selling products, any supplies you bought to create your products or deliver your service, packaging materials, shipping costs, advertising expenses if you run online ads, maybe even home office expenses if you qualify as a small business or freelancer working from home.
Each one reduces taxable income.
Each legitimate deduction directly reduces your taxable income, sometimes by thousands of dollars over the year. Don't leave that money on the table for the IRS. You also, as we said, need to track all the refunds you issued. That's a separate category from expenses, but just as vital in reducing your reportable income because that money left your hands.
And as we just hammered home, you must meticulously distinguish between business income and purely personal reimbursements.
Yes. If you use the same payment app for both, this can get incredibly messy very quickly come tax time.
So, practical tips.
Consider setting up separate bank accounts. One purely for business income and expenses, one for personal stuff. If that's not feasible, then at the very least, keep incredibly clear, descriptive notes about the nature of each payment, both incoming and outgoing, in your own records.
Like in a spreadsheet or accounting software.
Exactly. For instance, if a friend sends you money for their share of that vacation rental, label it clearly in your records. Reimbursement Airbnb trip friend's name. Not just payment received. Be specific.
Okay.
This rigorous process, being your own financial detective, ensures that you can confidently align that reported gross amount on your 1099K with your actual, often much lower, taxable income.
And without those records.
Without clear, organized records, you risk paying tax on money that wasn't truly your profit, or even worse, paying tax on money that wasn't income at all, like those reimbursements. It's really about empowering yourself, giving yourself the data to accurately and defensively represent your financial situation to the IRS.
I like the odometer analogy you used earlier.
Yeah, think of the 1099K as the odometer reading. It tells you how far you've driven in terms of gross transactions, big number.
Okay.
But it doesn't tell you how much gas you used to make that journey. Those are your deductible expenses. Or what your profit was from the journey, taking into account maybe tolls, maintenance, the original cost of the car itself.
My records fill in those details.
Your meticulous records fill in those crucial details. They are the undeniable proof of your actual financial reality. They enable you to claim all the eligible deductions and adjustments and avoid overpaying. Without them, you're just guessing. And guessing usually costs you more in taxes.
Okay. You've received your 1099K. You now understand what it reports that gross amount. And critically, you understand how to identify all those potential adjustments and deductions for tax savings. So what's the very first concrete thing you should do before you even start thinking about filling out your Form 1040?
Your absolute first step is reconciliation. RECONCILIATION.
Reconciliation, matching things up.
Exactly. As soon as that 1099K arrives, maybe even download it from the processor's website if you can. Compare the gross amounts and maybe the transaction counts reported on it with your own records.
My financial detective notes.
Your financial detective notes. Check your bank statements. Log into your PayPal dashboard, your Stripe dashboard, your Square reports, your Etsy sales reports, whatever applies to you, and cross-reference everything with your personal bookkeeping entries, whether that's a spreadsheet or software.
And those monthly breakdowns. Boxes 5A to 5 pound.
This is where they become incredibly useful. Go month by month. Diligently. Make sure your calculation of gross receipts for January matches their box 5A, February matches 5B, and so on.
And if they don't match?
That's your first red flag. You need to investigate why. Don't just ignore it or assume it's close enough.
Okay, so what if I do find discrepancies, the numbers don't match, or maybe I just have questions about where their total came from? What then?
Don't just guess or assume it'll sort itself out on your tax return. The instructions on the form itself are very clear and direct about this, they say. Contact the filer whose information is shown in the upper left corner on the front of this form.
Go back to the source again. PayPal, Stripe, Square, Etsy.
Exactly. They are the ones who generated the form. They have the underlying transaction data. They are your first and usually your only stop for getting corrections made.
And if I don't recognize that filer name.
Right. If maybe you used a less common platform or some kind of sub-processor, the form also advises to contact the PSE whose name and phone number are shown in the lower left corner of the form above your account number. That gives you that secondary point of contact we mentioned earlier.
Okay. And why is it so important to resolve this with them first, before filing taxes or calling the IRS?
It's absolutely crucial. You need to resolve any issues with the issuer first. They can investigate the discrepancy on their end, they can correct errors if they made one, and if warranted, they can issue a corrected 1099-K. It'll actually say corrected at the top.
Ah, a corrected version.
Yes. Trying to explain discrepancies to the IRS yourself without first getting that corrected form from the source, that's a much harder path. It's more time-consuming, could raise audit flags, potentially delay your refund. It's just much cleaner to get it right at the source.
So that upfront reconciliation and correction process.
It's a key step, ensuring accuracy, ensuring proper tax calculation, ensuring your peace of mind. Get it right with the payment processor first.
Good advice. Okay, so let's say I've done that. I'm confident in the numbers on my 1099-K, or the corrected one. I've reconciled it meticulously with my own impeccable records. Addressed any discrepancies. Now what? How does this form actually fit into my overall tax filing process?
Right, the big picture. The general guidance on the form is a bit broad. It just says, see the separate instructions for your income tax return for using the information reported on this form.
Helpful?
Yeah, not super specific. But there are more specific avenues depending on your situation, and the IRS points you towards them.
Okay, like what?
Well, if the Form 1099-K is related to your business activities, meaning you're selling goods or services with the intent to make a profit, like Sarah selling vintage or David freelancing, then the IRS directs you to Pub 334 for more information. That's Publication 334, Tax Guide for Small Business.
Pub 334.
Okay. This publication is absolutely key. It covers everything from how to report your business income, usually on Schedule C, Form 1040, profit or loss from business,
Schedule C.
to, critically, how to claim all your eligible business expenses and deductions. This is where you'd report that gross amount from the 1099-K as part of your total business receipts, and then you subtract all those costs we talked about.
The fees, refunds, shipping, cost of goods.
All of it, all your operational expenses, to ultimately arrive at your true net profit or loss, which is the number that actually flows to your main tax return and gets taxed. Pub 334 is really a goldmine for understanding how to properly report business income and maximize your deductions.
Okay, so Pub 334 for businesses. What about people more squarely in the gig economy? Driving, delivering, online freelancing.
The IRS has specific guidance tailored just for them too. The instructions say, if the Form 1099-K is related to your work as part of the gig economy, go to www.irs.gov gig economy.
A dedicated website section.
Yes, a whole section on the IRS website just for the gig economy. This resource will have specific guidance tailored to the unique deductions and reporting nuances for gig workers.
Oh, what kind of things?
For instance, it'll cover how to account for mileage if you're driving, vehicle maintenance, supplies, phone expenses related to the work, home office space if applicable, other common costs associated with being an independent contractor. It's designed to help gig workers understand how to manage income, maybe from multiple platforms, and claim every single deduction they are legally entitled to.
Very useful. And don't forget Box 4.
Right. Never forget Box 4, that federal income tax withheld.
Where does that go on the tax return?
That's not income. Remember, it's tax you've already paid. You must include this amount as tax withheld on your main income tax return, usually Form 1040. It gets added in with any other withholding, like from a W-2 job or any estimated tax payments you made.
And it directly reduces the tax I owe.
Directly reduces your total tax liability, dollar for dollar, or increases your refund. It's real money back in your pocket, essentially. Don't leave it unclaimed.
Okay. So I got my 1099-K reconciled. I know where the numbers go. I know about deductions. Now I'm ready to file. What are the recommended ways?
Well, the source material mentions requirements for the issuers of 1099-Ks to e-file if they have 10 or more forms, but the general encouragement for e-filing really applies to individuals filing their own returns too.
The IRS prefers e-filing.
They strongly encourage you to e-file even if you only have one form, like a 1099-K. And honestly, it makes sense. E-filing is almost always faster. It's significantly more accurate because the software has built-in error checks.
Catches mistakes.
Exactly, and it can simplify the process of importing data directly from forms like the 1099-K into tax software, reducing manual entry errors. It's just the modern, most efficient way to submit your return.
What about free options for filing?
Absolutely. For qualifying individuals, the IRS heavily promotes its Free File program. You can find it easily at www.irs.gov Free File.
Free File. What does it offer?
This program is fantastic. It offers no-cost online federal tax preparation, e-filing, and direct deposit or payment options through partnerships with various tax software companies. There are usually income limitations, but a large percentage of taxpayers qualify.
So you can use professional software for free.
Essentially, yes. It's an excellent, legitimate resource. It can be particularly helpful for navigating forms like the 1099-K and making sure you claim all those deductions we discussed, especially if your overall financial situation isn't super complex. Truly a valuable tool for making tax compliance accessible.
Great resource. And the IRS has other links too, right? Specific to the 1099-K.
They do, and we highly recommend checking them out directly for the official word. For more info on why you might have received a Form 1099-K, which is often the first question people have.
Yeah, why me?
Right. You can go to www.irs.gov Know Your 1099-K. That link often provides clear explanations for various scenarios that might trigger the form.
Okay, and for what to do with it.
For information on what to do with your Form 1099-K, which is exactly what we've been digging into today, there's www.irs.gov businesses What to Do with Form 1099-K. That page offers practical steps and often links out to other relevant publications like Pub 334.
And for the latest updates, tax laws change.
Crucial point. For the very latest developments related to Form 1099-K and its instructions, especially since reporting thresholds or rules can be adjusted by Congress or the IRS, always refer to the main form page, www.irs.gov Form N99K.
Straight from the source.
Always best. These official IRS links are invaluable. They offer direct official guidance. They can clarify many specific situations that might apply uniquely to you. They are your trusted sources. Don't rely on, random advice you find online when the official guidance is readily available right there.
Good advice. Stick to the IRS site for the final word. So, if we sort of zoom out now, connect this all to the bigger picture, the 1099-K isn't just a single form you might get in the mail. It feels like it's more than that. It's like a powerful signal, isn't it?
It absolutely is a signal. It signifies the IRS's growing capacity, their sophisticated data analytics, and their, frankly, unwavering focus on income generated within the digital economy.
They're paying close attention.
Very close attention. They are no longer operating in the dark when it comes to a lot of this online income. They have highly efficient tools like the 1099-K reporting system and a clear directive from Congress and internally to track these transactions. Compliance is more important now than ever before in this space.
So that means things like casual online selling, maybe some freelancing on the side.
Yeah, or even receiving significant amounts of peer-to-peer payments through these third-party networks. All of that is now much more visible to tax authorities than it ever was before.
No more under-the-radar income for many people.
For many, that's exactly right. What might have previously been considered minor or maybe informal income streams, things that maybe just didn't get reported, now they're being systematically reported directly to the IRS via these 1099-Ks.
And what does that demand from us?
It demands, or at least strongly encourages, critical thinking about how we manage our financial data, how we approach our tax compliance. The days of earning significant income digitally without leaving much of a trace, those days are rapidly coming to an end for most individuals. This whole shift really demands a proactive stance from every single participant in the digital economy.
And here's the crucial implication for you, the listener, right?
Mm-hmm.
Well, the IRS gets that high-level gross amount reported from the payment processor.
Right, they get the big number.
The onus, the responsibility, is entirely on you to accurately report your net taxable income.
100%. They have the top-line number from the 1099-K. But you are the one who possesses all the crucial details about the adjustments, the refunds, the legitimate business expenses that reduce that big number down to your actual profit.
Which underscores that need for proactive, organized financial habits.
Absolutely. It's not enough anymore to just have received money digitally. You need to be able to prove what your true taxable earnings were. To avoid overpaying, your records, they are your undeniable truth, your defense if needed.
So this really raises an important question for future planning, doesn't it? Looking ahead.
It does.
Right.
Are your record-keeping systems robust enough? Are they good enough to easily reconcile your next 1099-K and accurately report your taxable income without a massive headache?
What should people be thinking about?
Think about setting up a clear, consistent system now for tracking all your relevant income and all your relevant expenses throughout the entire year, not just scrambling frantically at tax time when that 1099 suddenly shows up.
Practical step.
Maybe it means investing in simple accounting software. Things like QuickBooks Self-Employed, Wave Accounting, FreshBooks, there are lots of options. Or maybe just using a dedicated, well-organized spreadsheet with categorized entries. Maybe even just setting up a dedicated folder for all your digital receipts and using a separate bank account strictly for your business or side hustle transactions.
See the 1099K not as a burden, but maybe as a catalyst?
Exactly. View this form as a catalyst, an opportunity to truly get your financial house in order. Because by proactively tracking everything, you ensure you're only paying what you legitimately owe, not a penny more. And you gain true control over your financial narrative when talking to the IRS.
Okay. We have taken a really comprehensive deep dive today into Form 1099K, your essential digital money map. We've uncovered that it's far more than just a piece of paper. It's really the IRS's direct view into your digital earnings stream.
A very clear view.
And we've explored how understanding that critical difference, the difference between the reported gross amount and your actual taxable income, through careful, meticulous record keeping, can genuinely empower you in your tax planning. It can help you avoid overpaying taxes and ensure you keep more of your hard-earned money.
Absolutely. And in a world where, let's face it, every digital transaction leaves a clear, traceable fingerprint, the real power for you isn't in trying to hide or avoid things. That's probably futile anyway.
Right.
The real power is in truly understanding. Understanding what counts as income, what counts as a legitimate deduction, and crucially, understanding precisely how to prove it with your records. So the question for you to think about is, how will you use this knowledge? How will you use this understanding to take absolute control of your financial narrative, to ensure you're paying only your fair share, not a single penny more, by being meticulously prepared for whatever the ever-evolving digital economy and the resulting tax forms send your way?
That's a powerful thought to leave you with. A real challenge for proactive financial mastery. Until next time, keep digging for those insights and keep more of your money